Is the marginal buyer still there following the events of the last few weeks and, what looks to be a difficult time politically?
Well, the marginal buyer is always there until they're not. So I would be hesitant to call a reversal of market direction until it's been well established. But simple fact is forward-looking returns are driven by starting valuations, and starting valuations are very, very high. So we're looking ahead over the coming decade, and on our asset allocation interactive website, we're forecasting forward-looking returns for U.S. stocks slightly below the rate of inflation over the next 10 years, which would mean a return of 1.5% to 2% per year, not even matching inflation, even including dividends. And so that's not a pretty place to be. It doesn't mean that there aren't opportunities. There are lots of markets around the world that are much more attractively priced. In fact, most of them are. But U.S. stocks look very frothy.
That's fascinating, Rob. You said a lot there. So you're not seeing inflation running away with itself anytime soon. And you're also absolutely not seeing the kinds of returns that we have been seeing from US stocks of any color, it would seem, whether it's small cap, large cap, or value or growth.
Well, value, I think, is very attractively priced relative to the market. Emphasis on relative to the market. US value stocks are a little cheap. International value stocks are very cheap, and emerging markets value stocks are extraordinarily cheap. So there are opportunities out there. I would go with international value or emerging markets value. Another outlier is Britain. Fears of a chaotic emergence from the EU remain in place in the market. And yet, one of the things I love to do is roll the clock forward 3 to 5 years and ask, what are things going to look like? Well, COVID won't be there. The movement away from the EU for Britain will be a fait accompli. They'll still be a global trade facilitator in their financial services community. They'll still be active in world markets. They'll still be exporting and importing with the EU, with the US, and with the rest of the world. So when you look at things from a longer term perspective, this is why mean reversion works. What's newly cheap tends to rebound because things don't turn out as awful as people fear. And what's newly expensive or frothy tends to return back to sensible valuations because things don't turn out as extraordinary as people are speculating in current prices.
Rob, what are the metrics that you are looking at that are giving you confidence that markets outside the US will perform better than the US in coming years?
Well, one of the metrics that I love is what's called the Shiller PE ratio. It's price relative to 10-year smoothed earnings, and that takes out the effects of the economic cycle. The highest PE ratio of the last half century, surprisingly, was in April of 2009 at the trough of the financial crisis. Why was that the highest PE ratio? Because earnings had disappeared. It was priced relative to nothing. It was huge. And the consequence of that is if you take a smoothed approach, averaging 10 years of earnings, you're taking out, you're mitigating the impact of troughs in earnings or peaks in earnings as we have today. One of the other nuances that I think gets far too little attention is that there's a very direct link between deficit spending and corporate profits. So I do think that the likelihood of a Biden administration engaging in continued massive stimulus could have the unintended consequence of an enormous surge in earnings and a stark rise in wealth inequality.